Look, I need you to stop what you're doing for the next 20 minutes, because what I'm about to show you is going to fundamentally change how you think about precious metals. And I'm not talking about some generic advice you've heard 1,000 times. I'm talking about something that's happening right now, in real time, that most people won't understand until it's too late. You know what's fascinating? Everyone's talking about buying gold and silver. Everyone's got an opinion. But almost nobody is asking the one question that actually matters. Why are the people who control the money doing the exact opposite of what they're telling you to do? Let me paint you a picture. It's March 2024. The World Gold Council releases their quarterly report. And buried in the data is something extraordinary. Central banks purchased 290 tons of gold in the first quarter alone. That's the highest Q1 purchase on record. But here's where it gets interesting. At the exact same time, mainstream financial media is running headlines like "Gold loses its luster" and "Why investors are moving away from precious metals." Do you see what's happening here? The institutions that literally print money are stockpiling gold at record pace while simultaneously telling retail investors it's a bad idea. That's not a coincidence. That's a strategy. Now, I want you to think about something. When was the last time a central bank went on CNBC and explained their gold purchases? Never. They don't need to convince you. They don't need your permission. They just quietly accumulate while the narrative machine tells you to look elsewhere. Let me take you back to 2008 for a second. Remember the financial crisis? Most people remember the bank failures, the housing collapse, the bailouts. But there's a story within that story that almost nobody talks about. In 2007, before everything fell apart, gold was trading around $650 an ounce. The Federal Reserve, the Treasury Department, every major financial institution was telling people the economy was strong. Subprime is contained, they said. The fundamentals are sound. Meanwhile, a small group of hedge funds and family offices were doing something very different. They were buying gold, not a little bit, massive positions. John Paulson, the guy who made billions betting against subprime mortgages, he didn't just short housing. He took a huge chunk of those profits and bought gold. By 2011, gold hit $1,900. The people who understood what was really happening didn't just survive the crisis. They thrived. But here's what most people miss about that story. It wasn't about predicting the crisis. It was about understanding the response. Paulson knew that when the system breaks, the people in charge only have one playbook: print money. And when you print money, you destroy its value. Gold doesn't care about your monetary policy. It doesn't care about your interest rate decisions. It just sits there being scarce while paper currency multiplies like rabbits. Fast forward to today. We're not in 2008 anymore. We're in something potentially much bigger. The M2 money supply, that's basically all the dollars in circulation, increased by 40% between 2020 and 2022. 40% in 2 years. That's not economic policy. That's desperation dressed up in a suit. And here's the thing, nobody wants to say out loud. They can't stop. The system is built on debt. The US government is paying over $1 trillion a year just in interest on the national debt. Think about that. Not paying down the debt. Just the interest. That's more than the entire defense budget. The only way to service that debt is to keep the money printer running. And every dollar they print makes your savings worth less. Now you might be thinking, okay, but the Fed raised interest rates. They're fighting inflation. Problem solved. And that's exactly what they want you to think. But let me show you what's actually happening beneath the surface. When the Fed raises rates, it makes borrowing more expensive. That's supposed to slow down the economy and reduce inflation. Economics 101, right? But here's the problem. The biggest borrower in the world is the US government. So when rates go up, the government's interest payments explode, which means they need to borrow more money to pay the interest on the money they already borrowed. You see the trap? There's only 2 ways out of this. Option 1, default on the debt. Not going to happen. That would destroy the dollar's status as the world reserve currency overnight. Option 2, inflate the debt away. Print so much money that the debt becomes meaningless in real terms. That's the path they're on. That's the only path they can take. And the central banks know this. That's why they're buying gold. China's central bank has been buying gold for 17 consecutive months as of mid-2024. 17 months. They're not doing that because they think it's a good investment. They're doing that because they're preparing for a world where the dollar isn't king anymore. Let me tell you about something that happened in 2023 that should have been front-page news but barely got mentioned. The BRICS nations, that's Brazil, Russia, India, China, and South Africa, announced they're working on a new currency for international trade, a currency backed by commodities, including gold. Now, you might think, so what? Some countries want to trade in a different currency. How does that affect me? Here's how. The US dollar's power comes from the fact that everyone needs it. If you want to buy oil, you need dollars. If you want to participate in international trade, you need dollars. That demand for dollars is what allows the US to print unlimited amounts of money without immediate consequences. But what happens when countries don't need dollars anymore? What happens when they can trade oil, wheat, copper, everything, in a currency that's actually backed by something real? The demand for dollars collapses. And when demand collapses, value collapses. This isn't theory. This is happening right now. Saudi Arabia, the cornerstone of the petrodollar system, just announced they're open to selling oil in currencies other than the dollar. That's a seismic shift. That's the foundation cracking. And while all this is happening on the macro level, there's something equally important happening in the physical market that most people don't understand. The COMEX, that's the major exchange where gold and silver futures are traded, has a problem. A big problem. Here's how it works. When you buy a gold futures contract on the COMEX, you're not actually buying gold. You're buying a promise that you can get gold at a certain price on a certain date. Most of these contracts never result in physical delivery. People just trade the paper contracts back and forth. It's basically a casino where gold is the theme. But here's the thing. The COMEX has way more paper gold than actual physical gold. We're talking ratios of 100 to 1 or higher. For every ounce of real gold in the vault, there are 100 paper claims on that gold. As long as everyone's happy trading paper, the system works. But what happens when people start asking for the real thing? We got a preview of this in March 2020. When COVID hit and the world went into lockdown, something strange happened in the gold market. The paper price of gold in New York and the physical price of gold in London diverged by $70 an ounce. That had never happened before. Why? Because the people who owned paper gold suddenly wanted physical gold, and there wasn't enough to go around. The COMEX had to emergency fly physical gold from London to New York to prevent a complete breakdown of the system. They literally chartered planes to move gold across the Atlantic because the paper market was about to be exposed as a fraud. That was a warning shot. And it's going to happen again, except next time it's going to be bigger. Because now you've got central banks competing with investors, competing with industrial users, all trying to get their hands on physical metal in a market that's been running on paper promises for decades. Let me shift gears for a second and talk about something that hits closer to home for a lot of people. Retirement accounts. You've probably got money sitting in a 401k or an IRA. Maybe it's in stocks, bonds, mutual funds, traditional stuff. And you've been told that's the safe, responsible way to save for retirement. But think about what those assets actually are. Stocks are ownership in companies that operate in dollars. Bonds are promises to pay you back in dollars. Mutual funds are just baskets of stocks and bonds. Everything in your retirement account is denominated in and dependent on the dollar maintaining its value. What happens to your retirement when the dollar loses 30%, 40%, 50% of its purchasing power? Because that's not a hypothetical. That's what happened in the 1970s. From 1971 to 1980, the dollar lost more than half its value. People who retired in 1971 thinking they had enough money found themselves struggling by 1980 because their dollars didn't buy what they used to. And here's the kicker. The conditions today are worse than the 1970s. The debt is higher. The money printing is more extreme. The geopolitical tensions are more severe. We're not heading into a 1970s style crisis. We're heading into something that could make the 1970s look mild. Now, quick aside here, and this is important. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how you can get physical gold into your retirement account without triggering tax penalties. It's worth checking out if that's relevant to your situation. I'm not saying it's right for everyone, but it's something you should at least understand. All right, back to what's happening in the market right now. Because there's another layer to this that most people completely miss. The silver story. Everyone talks about gold. Gold is the safe haven. Gold is the store of value. And that's all true. But silver? Silver is something different. Silver is the most undervalued asset in the world right now, and I can prove it. Go back to 1980. The gold to silver ratio, that's how many ounces of silver it takes to buy 1 ounce of gold, hit 15 to 1, meaning 15 ounces of silver equaled 1 ounce of gold. That ratio is based on the historical abundance of the metals in the Earth's crust. There's roughly 15 times more silver than gold in the ground. Today, that ratio is around 85 to 1. It takes 85 ounces of silver to buy 1 ounce of gold. That's not normal. That's not sustainable. And it's not because there's suddenly more silver in the ground. It's because silver has been suppressed, manipulated, and undervalued for decades. Why? Because silver is both a monetary metal and an industrial metal. It's used in solar panels, electric vehicles, electronics, medical equipment, everything. The world needs silver to function. And if the price of silver accurately reflected its scarcity and utility, it would cause massive disruptions in industrial supply chains. So the price has been kept artificially low through the same paper market manipulation that happens with gold, except with silver, it's even more extreme. The physical market is even tighter. The above-ground stockpiles are even smaller relative to demand. Here's a number that should terrify anyone who understands supply and demand. Global silver mine production is around 830 million ounces per year. Global silver demand, including industrial use and investment, is over 1 billion ounces per year. We're consuming more silver than we're producing, every single year. Where's the difference coming from? Existing stockpiles, recycling, secondary sources. But those aren't infinite. At some point, and we might be very close to that point, the physical market runs out of buffer. And when that happens, the paper price and the physical price are going to diverge so dramatically that the entire pricing mechanism breaks down. Imagine trying to buy silver and being told, sure, we can sell you a contract for silver at $25 an ounce, but if you want actual physical silver, that's $50 an ounce. That's not hypothetical. That's what happened with palladium a few years ago. The paper price and the physical price completely disconnected. And when that happens with silver, it's going to cascade into gold, into the entire precious metals market, into the currency markets, into everything, because it's going to expose the fact that the emperor has no clothes. The whole system is built on paper promises that can't be kept. Now, let me tell you about something that happened in 2023 that perfectly illustrates where we are. First Republic Bank collapsed. It was the second largest bank failure in U.S. history. And how did it collapse? A bank run. People got scared, they pulled their deposits, and the bank didn't have the money. But here's what's interesting. First Republic wasn't some sketchy operation. It was a well-respected bank with wealthy clients. It had passed all the regulatory stress tests. It was supposed to be safe. And it collapsed in a matter of days. Why am I telling you this? Because it shows how fragile the system is. Banks don't actually have your money. They have a fraction of your money. The rest is loaned out, invested, tied up in assets that can't be liquidated quickly. It's called fractional reserve banking, and it works great until everyone wants their money at the same time. The same principle applies to the precious metals market. The COMEX doesn't have all the gold. The bullion banks don't have all the silver. They have a fraction, and they're counting on the fact that not everyone will ask for physical delivery at the same time. But what happens when they do? What happens when the trust breaks down? What happens when people realize that the paper they're holding isn't actually backed by metal? You get a rush to physical. You get premiums exploding. You get delivery delays stretching from weeks to months. You get dealers running out of inventory. And you get prices that bear no resemblance to what the futures market says the price should be. We saw glimpses of this in 2020. We saw it again in 2022 when inflation started running hot. Each time, the system bent, but didn't break. But it's getting weaker. The cracks are getting bigger. And the next time might be the time it actually breaks. Let me give you another historical parallel, because history doesn't repeat, but it sure does rhyme. In 1971, President Nixon closed the gold window. That means he ended the convertibility of dollars into gold. Before that, foreign governments could exchange their dollars for gold at a fixed rate. After that, the dollar became a pure fiat currency, backed by nothing but trust. Why did Nixon do that? Because the U.S. didn't have enough gold to back all the dollars it had printed. Foreign governments, particularly France, were calling the bluff. They were showing up with dollars and asking for gold. And the U.S. was running out. So Nixon changed the rules. He said, sorry, no more gold. Dollars are dollars, take it or leave it. And the world took it, because what choice did they have? The U.S. was the dominant economic and military power. But here's the thing. That only works as long as you're the dominant power. As long as everyone needs your currency. As long as there's no alternative. Today, there are alternatives emerging. The BRICS currency, bilateral trade agreements that bypass the dollar, central banks diversifying their reserves into gold. The dominance is eroding. And when it erodes enough, the US won't be able to just change the rules anymore. What does that mean for you? It means the dollars you're holding, the dollars in your bank account, the dollars in your retirement account are at risk of losing value in a way that most people can't even imagine. Not slowly over time, rapidly, catastrophically. And the people who are prepared for that, the people who have moved some of their wealth into hard assets, into things that can't be printed or devalued by government decree, those are the people who are going to preserve their purchasing power. Let me tell you about a guy named Rick Rule. He's a legendary resource investor. Been in the game for over 40 years. He's made fortunes in precious metals, mining stocks, all of it. And he says something that I think is profound. He says, you don't buy gold because you think it's going up. You buy gold because you think everything else is going down. That's the mindset shift that most people need to make. This isn't about getting rich quick. This isn't about timing the market perfectly. This is about preserving what you have. It's about making sure that the wealth you've accumulated over your lifetime doesn't evaporate when the monetary system resets. Because make no mistake, a reset is coming. It might be a slow, grinding devaluation. It might be a sudden crisis. But the trajectory we're on is not sustainable. The math doesn't work. The debt can't be repaid. The only question is how it resolves. And when it does resolve, the people holding paper are going to get crushed. The people holding assets with intrinsic value are going to be okay. It's that simple. Now, I want to address something that I hear all the time. But gold doesn't pay dividends. It doesn't generate cash flow. It just sits there. And that's absolutely true. Gold is not an investment in the traditional sense. It's insurance. It's a hedge against the system failing. You don't buy fire insurance on your house because you think your house is going to burn down. You buy it because if it does burn down, you want to be protected. Gold is fire insurance for your financial life. And here's the thing about insurance. You don't wait until the fire starts to buy it. You buy it when things are calm, when you can think clearly, when you're not panicking. Right now, we're in that window. Things feel relatively stable. The stock market is near all-time highs. Unemployment is low. People are going about their lives. But beneath the surface, the pressure is building. The debt is growing. The money printing continues. The geopolitical tensions are escalating. This is the time to prepare, not when the crisis hits, not when premiums are through the roof and dealers are sold out. Now, let me give you one more piece of the puzzle, something that ties all of this together. The energy crisis. You probably remember 2022. Energy prices spiked. Gas was over $5 a gallon in the US. Europe was facing blackouts. Natural gas prices went parabolic. And everyone was talking about Putin and Ukraine and sanctions. But here's what most people missed. The energy crisis isn't about Putin. It's about decades of underinvestment in energy infrastructure. It's about the transition to green energy happening faster than the technology can support. It's about the fact that we've been consuming more energy than we've been discovering for years. And energy is the foundation of everything. You can't mine gold without energy. You can't transport goods without energy. You can't manufacture products without energy. When energy gets expensive, everything gets expensive. And what happens when everything gets expensive? Inflation. Real, persistent, structural inflation. Not the kind that the Fed can control with interest rate hikes. The kind that's baked into the system because the underlying costs are going up. Gold and silver thrive in that environment because they're real assets. They have intrinsic value. They can't be inflated away. When the cost of everything else is going up, precious metals go up too, because they're priced in the currency that's being devalued. This is why the 1970s were such a golden age for gold, pun intended. Energy crisis, inflation, currency devaluation. Gold went from $35 an ounce to $850 an ounce. A 24 times return in less than a decade. We're setting up for a similar scenario now. Except this time, the starting point is higher. The debt is higher. The money printing is more extreme. The potential upside is even bigger. But here's the critical thing. You have to position yourself before the move happens. Once gold is at $3,000, $4,000, $5,000 an ounce, everyone's going to want it. The premiums will be insane. The availability will be limited. You'll be competing with institutions, with central banks, with everyone who waited too long. The time to act is when it feels early, when your friends think you're crazy, when the mainstream media is telling you precious metals are a bad idea. That's when the smart money moves. And make no mistake, the smart money is moving. Billionaires are buying ranches in New Zealand. Family offices are accumulating physical gold. Hedge funds are taking positions in mining stocks. They're not doing this because they're pessimistic. They're doing this because they're realistic. They understand that the system we've been living in for the past 50 years, the system of unlimited debt and money printing and dollar dominance, is coming to an end. And they're positioning themselves for what comes next. You have the same opportunity. You have access to the same assets. You can buy gold. You can buy silver. You can protect yourself. The question is, will you? Or will you wait until it's too late? Until the crisis is obvious to everyone? Until the prices have already moved and the opportunity has passed? I can't make that decision for you. But I can tell you this. Every single person I know who understands how the monetary system works, who understands the debt dynamics, who understands what's happening with central banks and currencies and geopolitics, every single one of them owns precious metals. Not because they're gold bugs, not because they're conspiracy theorists, but because they've done the math, they've looked at the data, they've studied history, and they've come to the inescapable conclusion that holding paper currency in a world of unlimited money printing is a losing game. The only question is how much of your wealth you want to protect. 5%, 10%, 25%? That's a personal decision based on your situation, your risk tolerance, your time horizon. But something is better than nothing. Because when the reset comes, and it will come, the difference between having some precious metals and having none could be the difference between maintaining your standard of living and watching your life savings evaporate. This isn't fear-mongering. This is pattern recognition. This is understanding that what's happened before will happen again. Currencies fail. Empires decline. Systems reset. It's not a matter of if, it's a matter of when. And the people who prepare, who take action while there's still time, those are the people who come out the other side intact. Those are the people who preserve their wealth. Those are the people who protect their families. So don't buy another ounce until you understand what you're really buying. You're not buying a commodity. You're not buying an investment. You're buying insurance against a system that's breaking down in real time. You're buying protection against the greatest monetary experiment in human history coming to its inevitable conclusion. And once you understand that, once you really grasp what's at stake, the decision becomes obvious. The only question left is how much you're willing to protect.